Kumarswami शिक्षण प्रसारक मंडल Shri Kumarswami College Ausa heartily welcomes all the honorable dignitaries and participants here on the virtual dais for the national webinar. Today's national webinar is the part of a long webinar series, mega webinar series, which was started on the occasion of the Golden Jubilee year of the institution. The theme of the webinar series is to exchange knowledge, to enrich knowledge, and after the keynote speeches, through the questions and answers, through the discussions, try to find out answers to questions and solutions to problems. These can be useful for the individuals, the society, and the nation. The attempt of webinar series has become successful, and it is because of the chief organizer and chairperson of this webinar series, Honorable Principal Dr. M. Ambedkar sir, and strong moral support of the institution. In the beginning of this webinar, I welcome Honorable Principal as the chairperson of this webinar. Today I am very happy to inform all the audience that we have the honorable dignitary and keynote speaker, Dr. Anupreet Kaur Mokha, Assistant Professor from SGTB Khalsa College, University of Delhi. She is going to enlighten us on the topic Personal Tax Planning and Introduction. On behalf of the organizing committee of Shri Kumarswami College Ausa, I heartily welcome you, ma'am, as an invited speaker and the chief guest of this national webinar. I also welcome all organizing committee members, including Vice Principal Dr. S.D. Misal sir, Junior College Supervisor Ravindra Karanje sir, MCVC Supervisor Praveen Utge sir, IQAC Coordinator Dr. Sanjay Kale sir, Dr. Anita Dole ma'am, Dr. Sudhir Garad sir, Ambadas Khillare sir, Dr. Patwari sir, and Dr. Wadkar sir. We all are here to listen the keynote speech. But prior to it, I request Dr. Anita Dole ma'am to introduce today's resource person. Please ma'am, welcome.
Thank you, sir. A very good evening to one and all. You are welcome to this grand national and international webinar series on occasion of Golden Jubilee year of the college. Shri Kumarswami Mahavidyalaya Ausa has organized a wonderful grand knowledge sharing webinar series with the aim of women empowerment and women dignity. So from pandemic days, the series is going on very systematically and very successfully because of the hard efforts of the respected principal Dr. Ambedkar MM, all the resource persons and the punctual participants. I would like to thank respected principal Dr. Ambedkar MM for giving me this opportunity to introduce resource person on this virtual platform. Many special thanks goes to all the respected organizing committee members and big thanks all the respected participants. So it's my pleasure I am here to introduce today's keynote speaker, Honorable Dr. Anupreet Kaur Mokha ma'am, who is Assistant Professor at SGTB Khalsa College, University of Delhi. Title of speech is Personal Tax Planning and Introduction. Ma'am has completed M.Com. She is NET qualified and completed PhD from University of Delhi. She secured a merit and continuous rank holder throughout the academics. She has been awarded Sultan Chand Memorial Scholarship and SS Gulshan Memorial Scholarship for Excellence in Commerce for Academic Topper in M.Com. She has given the guest lectures and delivered so many talks on different topics. She has published and presented number of research papers on national and international level. So after this introduction, I request today's keynote speaker, Dr. Anupreet ma'am. Please start your presentation. Thank you. Welcome ma'am.
A very good evening, everyone. First of all, I would like to thank Dr. Bedkar sir for giving me this opportunity and Prakash sir and Neeta ma'am for introducing me. So let me just show my presentation. So the topic of my presentation is the personal tax planning. So that is an introduction. So first of all, by moving ahead with the personal tax planning, so first comes is the what do you mean by tax? So tax is nothing but the compulsory financial charge which is being imposed on the individual by the government. So it is not a voluntary or something that you can rid of. It is something that is compulsory levied on the taxpayers who is basically who are required to pay the tax. So when it comes to the tax, next piece comes is the income tax, which is all about the basically the tax which is payable on the income of the customers or the income of the taxpayers. That is basically known as the income tax. It is the direct tax which is payable on the taxable income of the person, and it is one of the most significant direct tax which we cover today, and it is the major source of revenue for the central government. So the provisions of the income tax, they were contained in the Income Tax Act 1961, so which came effective on 1st April 1962, and it includes all for India, including Jammu and Kashmir. So income tax law includes various things. Firstly, it includes the laws, that is 1961. Then it includes the tax rules, but all rules will be covered under this. Income tax is given under 1962 rules. Then it also includes the circulars, clarification which has been issued from time to time by the Central Board of Direct Taxes, that is various amendments which is to be included, or various provisions, circulars which are to be included, or any clarification regarding the notification. Everything is given by the Central Board of Direct Taxes, and also the judicial decision, that is the case laws, due to which what all can be done, all the court decisions will lead to the particular case laws and everything. That includes all these four things, that is the laws, rules, as well as the circulars, as well as the judicial decisions. So next comes is, before moving ahead with the personal tax planning, we should know aware about the basic framework, what is behind the income tax. So first thing which comes is the previous year, that is section 3. So what is this previous year we basically mean? So it is that year in which the income is earned. So we basically earn the income in one financial year. So financial year starts from 1st April till 31st March. So in this particular financial year, what all income we have earned is the previous year. So it is the financial year immediately preceding the assessment year. So we'll talk about what is this assessment in the next slide. So financial year means year which starts from 1st April and it ends on the 31st March. So it can be possible that your first previous year can be less than 12 months. That basically in case of the newly set up business or the profession. So generally previous year can never exceed a period of 12 months. It can be equals to or less than 12 months. So that is the previous year. In that particular year, we are earning the income. So what we have earned in the previous year will be taxable in the assessment year. So it means the period of 12 months starting from 1st April ending on 31st March of the next year. So it is the year in which the total income earned during the relevant previous year is assessed and taxed. So suppose if we take the previous year as 2021-22, that is from 1st April 2021 till 31st March 2022, if we have earned any particular income in this time period, so in this time period, whatever income we have earned, now we have to pay it in the next assessment year, that is the common financial year, that is from 1st April 2022 till 31st March 2023. That is particular assessment year which we have to pay our previous year taxes. So in an assessment year, an SSC is required to file the return of income tax for the previous year. The current assessment year is 2022-23, in which we have to file our ITR, that is the income tax return for the previous year, that is 2021 to 2022. after that particular total income which we are getting, we have to round off that also particular. So the total income which we are getting should be rounded off to the nearest multiple of 10 rupees. So if the last figure is 5 or more, we have to increase it to the next multiple of 10, and if it is less than 5, then we have to reduce it. So for example, if the total income is 8,79,467, so since the last figure is more than 5, so the amount will be 8,79,470. That is, you have to increase it to the next multiple of 10. Similarly, when you round off your total income, you have to round off your tax as well. The same is, that is, you have to round off to the nearest 10 rupees. If it is more than 5 rupees or 5 or more, then you have to increase it to the 10 rupees. And if it is less than 5 rupees, then you have to ignore it. That is the basic framework, what is about income tax. Now let's come to the what is tax planning. So what do you basically mean by tax planning? So tax planning is nothing but that is the activity which has been undertaken by the SSC to reduce the tax liability by making the optimum use of all the permissible allowances, deductions, concessions, exemption, rebates, etc. available under the statute. So what is the main aim of the tax plan? So the main aim of the tax plan is to reduce the that is tax liability. What we want is we want to minimize our tax liability. So if we are reducing our tax liability by making use of the permissible allowances, deduction, whichever is available in the income tax. So if we are making the optimum use of such deductions, and that is within the legal framework, if we are reducing our tax liability, so that is known as the tax planning. That is, you are saving your taxes within the legal obligations or requirements of the Income Tax Act. So that is tax planning is ethical. So let's take one example. So X is an individual for the assessment year 22-23. His gross total income is 12,90,000. So looking at, suppose we have taken the old tax regime only. So in that case, that particular gross total income is 12,90,000. So on that, he has to calculate the tax. So using this tax calculation, we get the tax amount as 2,07,480. So the tax on rupees 12,90,000 is 2,07,480. If that particular person, that is X, if he wants to reduce his tax liability using the maximum possible deduction which is available under the income tax, so what he has done is he has invested rupees 1,50,000 in public provident fund account, that is PPF, in which you get the deduction under section 80C, and you can claim maximum deduction under section 80C as 1,50,000. So for example, he deposited rupees 1,50,000 in the PPF account. So consequently, his taxable income and tax liability will also get reduced. So his tax liability was 12,90,000. By investing rupees 1,50,000, his taxable income reduces to 11,40,000, and on that 11,40,000, if we calculate the tax, then his net tax income would be 1,60,680, and earlier it was 2,07,480. So in this way, he has reduced his tax liability, that is within the legal framework. So this is known as tax planning. That is, you are minimizing your tax liability by making the optimum utilization of all the permissible deductions. So next comes is what are the objectives of tax planning. So first comes is the reduction of the tax liability, which I've already discussed. Next comes is the minimization of the litigation. So there is always a warlike situation between the taxpayers and the tax collectors. So what the taxpayers they want to minimize the tax liability, and what the tax collectors they want to extract maximum taxes from the taxpayers. So there should be a minimization of the litigation. So with prudent tax planning, the litigation, there will be an incidence of litigation will be minimized. Next is the productive investment. The taxpayers, what they can do is they can channelize their investments into the productive channels. They can invest in various investment plans, such as are reducing your tax liability using the legal requirements only, but you are defeating the basic intention. That is, you are using the loopholes that prevails in the income tax. If you are using the loopholes, that is, you are taking the benefit of the loopholes, in that case, you are doing the tax avoidance. You are avoiding the tax using the loopholes that exist in the tax laws. So, for example, if rupees 51,000 is gifted by husband to his wife on their first marriage anniversary, and any income which you have generated from that particular income is taxable in the hands of the husband. See, this is the clubbing provision which I was talking about. So that is the first one basic example of clubbing provision is if any amount is gifted by husband to his wife, that is individual to his wife, then any income which is generated from that particular income will be taxable in the hands of the husband under the clubbing provision. But this particular section is not applicable where the money is gifted by karta of family to his wife. So in case of HUF, this particular section is not available. So that is the loophole which the karta can use to adjust his income to reduce his tax liability. So tax liability in this case by the karta can be reduced, which will be by using the loophole in the law but within the legal framework. So that particular thing is known as the tax avoidance. That is, you are using the loopholes that prevails in the income tax. Next comes is the tax evasion. That is the if any individual is making the false claims to reduce his tax liability or providing any information regarding his total income. So you are reducing your tax liability using the dishonest means. That is, you are stating an untrue statement knowingly, or you are submitting the misleading documents, or the omission of material facts on assessment. All these accounts for the tax evasion. So the tax evasion is illegal act as well as immoral, anti-social and anti-national act. So to deal with such kind of direct taxes, they have made strict provision. That is, will be imposed by heavy penalties, or it can be imprisonment as well. So for example, Mr. X earned rupees 2 lakh last year, but he claimed only 1,50,000 on his tax return. So he has hid 550,000 in his income. So this is the case of the tax evasion. So next comes is the tax management. So it basically implies to the compliance to the statutory provisions of the act. That is, you are managing the finances for the payment of the taxes or the advance tax which you have to pay in time. So that is the filing of return. That is, e-filing is your tax management only. That is the operational aspect of your payment of taxes. That is, you have to pay the tax on your income. So that particular point is known as the tax management. That is, you are managing the finances so that you can pay your tax well on time. So next comes is how a person will plan his income. So there are two types of tax planning. First is the short-term tax planning, which basically lasts for 1 year, up to 1 year. That is, if your objective is to plan your taxes for up to 1 year, then you can known as the short-term planning. If your planning is for longer period, suppose if you are investing in the mutual funds, so for that the minimum is 3 years, lock-in period is 3 years. Next comes is the fixed deposits, can be for 1 year as well, can be for extended to 2 years, 3 years, more than 5 years, 6 years, and so and so. So that is the two types of planning you can be done. That is the short term as well as the long term, depending upon the period. Next is what are the factors on which the tax planning is done. So there are two things, that is the residential status and the citizenship and the heads of income. Let's discuss it one by one. So what is this residential status? So any chargeability of his or her income depends on the residential status. So what is the residential status of an individual? That will depend whether particular income will be chargeable to tax or not. So total income of an assessee cannot be determined without first ascertaining the residential status. So whatever income you are including in the residential status will be taxable accordingly. So every person for each previous year independently. So for this residential status will be calculating for every person for every previous year. So it can be possible in this previous year the person is non-resident, in the next previous year the person is resident. So it can be determined for each category of the person, that is the individual, HUF, AOP, BOR, company. So like citizenship of a country and the residential status, these are both different concepts. A person can be an Indian national citizen, but the rule for the residential status. So for an individual to be a resident in India, he has to satisfy any of the basic conditions. That is, if he stays in India for a period of 182 days or more during the relevant previous year. So for example, if we take the relevant previous year as from 1st April 2021 to 31st March 2022, if he stays in India for a period of 182 days or more, we can say that particular person is a resident in India. Or if in case he stays in India for this particular relevant previous year only for 60 days, and in the previous 4 years, that is immediately preceding the relevant previous year, if he stays in India for 365 days or more, then in that case also the person will be treated as a resident in India. So for treating a person as a resident, any of the two basic conditions can be satisfied. If none of the two basic conditions have been satisfied, then that particular person will be known as the non-resident in India. So if the person is treated as a resident, so there are further two categories, that is the ordinary resident and the not ordinary resident. So for ordinary resident, 2 additional conditions should be satisfied, both these conditions. That is, out of 10 previous year, in 2 previous year, at least 2 previous year, he should be a resident in India. And during the last 7 years, at least 730 days, he should be in India. So that is the conditions for the ordinary resident, and both these additional conditions should be satisfied. Whereas in case of not ordinary resident, if any of the additional condition is not satisfied, in that case the person will be treated as a not ordinarily resident. So there are few exceptions also, in which cases only 182 days or more thing will prevail. That is, any Indian citizen who leaves India during the previous year for the employment outside India, or if he is a member of crew of Indian ship, or if he is a person of Indian origin. That is, Indian origin means if his parents or if his grandparents, they were born in undivided India, that is India, Pakistan, Bangladesh. If they are born in that undivided India, in that case that particular person will be known as Indian origin. So in these 3 cases, only the first basic condition, that is of 182 days or more, will be prevailed. So in this way, we get that what is the residential status of individual. So in India, the residential status, if we look at the tax perspective, so the non-resident, guys, in case of non-resident, there is no taxable. That is, non-resident is not liable to pay tax in India. That is, if the source is India, that is on the Indian income, the non-residents, they are not liable to pay any tax. So what will be the tax planning? If you want to reduce your tax liability, so what you can do is you should enjoy the status of the non-resident status. So you should avoid stay in India for more than 181 days. If that is the first basic condition, says if you stay in India for 182 days or more, you will be a resident in India. So if you stay in India for less than 182 days, then in that case you will be treated as non-resident. And if the second basic condition is, that is 60 days or 365 days, I think, in that case, if in the last 4 preceding years, if your stay in India is not exceeding 364 days, then in that case also you will enjoy the status of the non-resident in India. So ultimately the tax planning is, you should plan your visit in India in such a way that in that case you will be treated as a non-resident. If you are non-resident, in that case only foreign income will be taxable. So if individual having been in India for more than 365 days during the 4 preceding years, so they wish to stay in India for more than 59 days, so they should plan their visit in such a way that their 59 days should lie in between 2 previous years. So if, for example, if that particular person wants to stay in India for more than 59 days, and in the previous 4 years the perquisites which are either tax-free or taxable at the concessional rate. With that way, they can reduce their tax liabilities. Next is in case of the house property. So for the purpose of tax planning regarding the income from house property, so these are the broad propositions for that. So if a person has occupied more than 2 houses for his residence, so only 2 houses they can be used as a self-occupied, and all other houses are deemed to be treated as deemed to be let out. So for example, if there is one person who owns more than 2 properties, suppose he owns 3 properties as a self-occupied is for his own residence. So as per the income tax, only 2 properties can be taken as a self-occupied and 1 property will be treated as deemed to be let out. So he has to make a prudent decision as to see which 2 properties should be taken as a self-occupied and which one should be taken as a deemed to be let out, so that he can reduce his tax liability. Also, as I've already told you, that is under section 24B, you can claim the exemptions. That is for any, if you have taken any borrowed capital on that particular borrowed capital, if you are paying any interest, you can claim as a deduction. Also, the municipal taxes, you can claim if you are municipal taxes is basically deductible on the payment basis. That is on when you have paid the tax. So when you are everyone should ensure that you are paying the tax during the previous year. Only then you can claim it as a deduction. So if you are not paying the taxes, the outstanding municipal taxes, you cannot claim it as a deduction under the income from house property. So make sure you are paying the income municipal taxes well on the time in the previous year. Next comes is the tax planning in respect of the business income. So make sure all the deductions which are available under this head should be carefully considered, so as to have the prudent tax planning. Next comes is the income tax planning in respect of capital gains. So the long-term capital gain, they attracts lower tax rate as compared to the short-term capital gain. So the tax liability in case of long-term is lesser than the tax liability in case of the shorter term. So it is always advisable to transfer your capital asset normally only after 36 months or 24 months or 12 months in few cases after the acquisition, because the tax rate which attracts the long-term capital asset is much lower than the as per the short-term capital asset. Apart from this, you can also take the exemptions from various sections which are available under the capital gains. And next is the tax planning in respect of the other sources. So that is the main part is the gifts part. So if you are getting any gifts from your relative or any gift on the marriage of an individual or under the will or by inheritance or by any local authority or by fund or educational institution, it is tax free. You don't have to pay any tax on that particular income. Whereas if you are receiving any gift from a you can say non-relative, in that case up to 50,000 it's exempted. After it, if the amount is exceeded by 50,000, then the total amount will be taxable. So make sure the gifts you are receiving should be less than 50,000 so as to minimize your tax liability. And tax planning overall, if we say, so the proper tax planning is the basic duty of every person. So first you have to compute your taxable income, then you have to calculate your tax liability. After you have calculated your tax liability, there are 3 options. That is, you have to pay your tax for which you have not done any planning. Second is, you can minimize your tax liability through prudent tax planning, or you can defer your tax liability to a later period. You can also defer your tax liability, that is, you can say you can deposit in some capital scheme, long-term capital scheme, or you can deposit some amount in your investment plan so that you can reduce your tax liability. So generally what the taxpayers do, they generally choose B and C options. They either reduce the tax liability or they're deferring the liability to a later period through appropriate tax planning. So what is this tax planning is the comprehensive analysis of the multiple needs simultaneously, and what you can use, you can choose among various investment plans, insurance plans, various tax saving schemes so as to reduce your tax liability. You have to compare the advantages of various tax savings available in the market, their return, their safety, measure everything, and then choose the appropriate plan at the right time. So what are the different options you can say for appropriate tax planning you can use to reduce your tax liabilities? Like what are these strategies? That is, you can invest in various fixed income plans, you can invest in life insurance to protect the family, you can use the procurement of the housing loans, you can use to provide maximum tax benefit, you can invest in the equity shares, mutual funds for the high returns, you can also invest in the retirement plans for the provision of regular income at old age, you can also invest in health insurance, provides additional tax benefits, also you can procure for the educational loan for is you just have to plan your tax liability in such a way that you are minimizing your tax liability within the legal framework under the tax law strategies. So that is regarding the personal tax planning. I hope so it's clear. I have tried my level best to give you an overview regarding the personal tax planning or the tax structure. Yes, sir.
Thank you, ma'am, for your detailed speech on the topic. Now I request participants, if they have any query, any doubt, any opinion, you can put it before the audience. Please.
Hello. Hello.
Yes.
Yes, sir. Yes. Go ahead.
सेक्शन 80D के बारे में अगर थोड़ा कुछ बता दें तो.
Section 80D is regarding the medical insurance. So in that case, if you are an individual, that is individual plus the family. So in that case, individual and family includes individual, their spouse and their children, that is the dependent children. And next comes is the parents, is the different part. So if you want to invest in the medical insurance, in that case, you can claim the maximum 25,000 as a deduction under section 80D. That includes the preventive health checkups as well, that is of rupees 5,000, which you can pay in cash, that is preventive health cash, you can health checkup for that, you can pay in cash also. But for the medical insurance, you have to pay the premium other than the cash. Whereas if you have a parents also including in that case, that is you are claiming medical insurance for your parents also. So in that case, again, additional 25,000 you can also claim for the parents. So in total, it's 50,000. That is for you and family plus the parents. And if in case the person, that is the individual or your parents, if that particular person is a senior citizen, so in that case, the amount will change from 25,000 to 50,000. So that is about the 80D section.
Thanks.
Is there any additional availability of reduction of tax for a psychiatrically ill patient?
Yes, sir. There are various sections for that as well. So there is like 80U is there for that particular illness section, disability section. There are various deductions available for that as well, in which there is a fixed amount, that is 75,000 you can claim if the disability is up to 40 to 50%, and if the disability is more than 80%, in that case you can claim maximum 1,25,000 also as a deduction. So there are various deductions also against the diseases as well.
Thank you, madam.
मैम एक पहला सवाल मेरा ये कि कितने महीने के बच्चे का पैन नंबर लिया जा सकता है. दूसरा ये कि एक माइनर बच्चे को अगर 5 साल तक कुछ 50-50 हजार रुपये, 6 लाख रुपए उसका डिपॉजिट है उसके नाम पर, और हर साल उसको 50,000 रुपये इंटरेस्ट आ रहा है, तो उसका पैन नंबर भी हो, तो वो कैसे किया जाएगा उसका?
सर, इन केस ऑफ माइनर चाइल्ड की जो भी आपकी इनकम होती है वो आपकी किसी इंडिविजुअल में, दैट इज हस्बैंड या वाइफ में क्लब होती है. एंड जो अगर माइनर चाइल्ड अगर वर्किंग है, तो इस केस में अगर नॉर्मल देखें, अगर वो वर्किंग नहीं है, तो माइनर चाइल्ड की जो भी इनकम होगी दैट विल बी अंडर क्लबिंग प्रोविजंस में आपका चला जाता है. सो इन दैट केस हस्बैंड एंड वाइफ में से जिसकी भी टैक्सेबल इनकम ज्यादा होती है, उसकी टैक्सेबल इनकम में क्या होता है, माइनर चाइल्ड की इनकम ऐड हो जाती है. So minor child तो वो टैक्स पे नहीं करेगा जब तक he is not at in that majority. So till that time जो भी husband and wife है, उन दोनों में से जिसकी भी taxable income ज़्यादा होगी, in that particular case उसमें taxability आपकी जो भी income है that will be added in that particular person, either husband or the wife. Yes sir, is it clear?
Is there anybody else with any more question, please?
मैम, यदि हमारा ईपीएफ है, पीएफ, तो मैक्सिमम पीएफ कितना कटा सकते हैं, लिमिट कितना है उसका, और एक्स्ट्रा यदि मेरा पीपीएफ अकाउंट है तो उसमें मैक्सिमम कितना कटेगा, और मेरे बच्चों का समझा पीपीएफ अकाउंट भी है तो उसको भी मैक्सिमम कितना हम कर सकते हैं?
पीपीएफ में आप मैक्सिमम 1,50,000 आप ले सकते हैं अंडर सेक्शन 80C, जो पब्लिक प्रोविडेंट फंड होता है। आप उसमें 1,50,000 तक की डिडक्शन क्लेम कर सकते हैं पूरे इंटायर 1 ईयर।
और मेरे बच्चों के लिए
आपके जो आपका जो भी आप पीपीएफ कर रहे हो वो क्लब ही होगा ना सारा का सारा, क्योंकि आपके जो बच्चे होंगे वो तो टैक्स अभी पे नहीं कर रहे होंगे, तो अल्टीमेटली अगर आप उनके बिहाफ उनकी तो टैक्सेबिलिटी अभी अराइज ही नहीं होगी। ये जो 1,50,000 की जो लिमिट है वो आपकी टैक्सेबल इनकम के अकॉर्डिंगली लाई करेगी। तो जो भी आपकी टैक्स लायबिलिटी है उसमें से आपके 1,50,000 एज अ डिडक्शन माइनस होगा। जो आपके चिल्ड्रन है उनके केस में उनकी टैक्स लायबिलिटी अभी अराइज ही नहीं होगी, उनकी तो टैक्सेबल इनकम ही नहीं है ना अभी।
Any more question?
and what is about PF?
का आपका basically provident fund, but itna I know that is you can the maximum exemption you can claim for the provident fund is 12% of your salary. That is the maximum exemption. After that, that is any amount exceeding 12% of your salary will be taxable. Whereas if any interest you are earning from that provident fund up to that 9.5% tak it will be exempted. Apart from that 9.5%, your taxability will arise, and that will be added in your income from salary.
Anybody else?
मैम पैन नंबर कितने महीने तक के बच्चे का लिया जा सकता है? सर मैं डिस्कनेक्ट हुआ, मेरे सवाल का ये जवाब नहीं आया या आपने दिया मुझे सुना नहीं।
पैन नंबर के लिए आई गेस जब तक अटेन नहीं करेंगे मेजोरिटी तब तक यू कैन नॉट क्लेम द पैन नंबर। फॉर दैट आपकी मेजोरिटी भी होनी चाहिए एज की।
थैंक यू मैम।
Any more question, please?
हेलो हेलो
यस यस सर।
मैम कोई बहू अपने सास ससुर के लिए अगर कोई मेडिकल खर्चा करती है तो वो क्लेम कर सकते हैं इनकम टैक्स में?
डॉटर इन लॉ करती है, डॉटर इन लॉ अपने किस हाँ यस यू कैन क्लेम डिडक्शन। आपका जो भी डॉटर इन लॉ का टैक्स फाइल कर रही हैं तो उनके वहां पर जो भी अपने इन लॉस के लिए अगर वो अपने जो आपका मेडिकल जो भी आप इलनेस एंड एवरीथिंग जो भी आप करते हैं उसमें आपका कौन कौन इंक्लूड होता है? आप होते हैं, आपके स्पाउस होते हैं, आपके डिपेंडेंट चिल्ड्रंस होते हैं। इन लॉस नहीं आते उसमें, इन लॉस नहीं आएंगे उसमें आपके, क्योंकि मेडिकल इंश्योरेंस में भी यही था। जो 80D की डिडक्शंस है फॉर फादर इन लॉ मदर इन लॉ जो भी आते हैं उसमें आप डिडक्शन स्कीम नहीं कर सकते।
Hello.
Anybody else?
Excuse me, ma'am. Madam, what is the provisions of NPS, madam? New pension scheme.
New pension scheme, for that particularly you can invest in the new pension scheme. For that there is a section that is 80CCD. You can get that is up to rupees that is 1,50,000, that is 80C plus 80CCC plus 80CCD1. That is the अगर आप new pension scheme में आप अगर invest करते हैं that is of the employee investment scheme, तो maximum आप 1,50,000 तक claim कर सकते हैं। इसके अलावा आपके पास एडिशनल बेनिफिट और आता है दैट इज अंडर CCD1B, जो कि एडिशनल 50,000 आप और इन्वेस्ट कर सकते हैं। तो टोटल आपका 2 लाख का बेनिफिट होता है। वेयरएज अगर आप एडिशनल नहीं करते तो आप टोटल 1,50,000 ही क्लेम कर सकते हैं। बट 80CCD1B जो कि एडिशनल इंडिविजुअल्स के लिए आया था, इन दैट केस आप 50,000 एडिशनल और इन्वेस्ट कर सकते हैं NPS में, जिसमें आपको टोटल 2 लाख की आपको टोटल 1,50,000 प्लस 50,000 2 लाख की इन्वेस्टमेंट आप क्या कर सकते हैं एज अ डिडक्शन क्लेम कर सकते हो फ्रॉम योर टोटल इनकम।
Thank you, ma'am.
Any doubt, any question? Honorable Dr. Anupreet Kaur ma'am has delivered a very nice and detailed lecture on the topic. It was illustrative, elaborate, and all of us have understood it very well. After the keynote speech, there was a very fruitful question answer session in which active participants of webinar series have taken part. Now after this keynote speech and question answer session, it is time for all of us to be audience for the concluding words of the chief organizer. So I request Honorable Principal Dr. M. Ambedkar sir for his concluding speech. Please sir, welcome.
Thank you, Professor Kaur sir, and today's resource person, Dr. Anupreet Kaur, Mokha madam, all the participants and organizing committee members of our college. It's the second time she is appeared here. Herself she have given a message. I would like to present my speech. Her academic career is so top quality, best teacher, net passed, everything is standard as a best teacher, and that's why she came ahead on this useful topic to speak on this topic. Every person up to some limit exempted from the tax, but nowadays no one is exempted. I was also question in mind. I have 3 homes, so today I decided to sell one home because of your speech. So this much minute things which we have to take care while preparing our tax, and these are the things are very useful to all participants, those who are joined here, maybe senior citizen or more senior citizen. Here also more most senior citizens are available here, and useful topic to all, and they also plan as per your suggestion and give some guidance also. They are tax consultant, and before that they are knowing something before discussing their consultant. So thank you madam, very useful topic delivered by you, and we also use such tips to go ahead while planning our personal tax. Thank you madam, thank you.
Thank you so much, sir. Thank you for giving me this opportunity. Thank you, everyone.
Now I am here for the vote of thanks. First of all, I would like to thank today's honorable keynote speaker, Dr. Anupreet Kaur ma'am, who has accepted the invitation of our college, spared her precious time to enlighten us on the topic. And the topic was so simplified that we understood it very well. So on behalf of the organizing committee of Shri Kumarswami College Ausa webinar series, I sincerely thank you ma'am for this keynote speech. I also thank Chief Organizer and Chairperson of this webinar series, Honorable Principal Dr. M. Ambedkar sir. He is an inspiration for all of us, and he is taking continuous efforts to run this webinar series and trying to put a variety of topics related with different fields so that our knowledge can be enriched and we can exchange our knowledge. So thank you sir on behalf of the organizing committee of Shri Kumarswami College Ausa webinar series. I also thank all the participants for their active participation, starting from regular joining, punctual joining, listening patiently, and taking active part in the question answer session. And these are the ones who have made this webinar series very successful. I also thank Dr. Anita Dole ma'am for giving introduction of today's honorably invited speaker. And now I request participants, please fill feedback link which is given in the chat box. We have your certificate, and at the end, with the permission of Chief Organizer, I announce here that today's webinar is over. Thanks to all. Thank you very much.
Thank you madam. Thank you madam, you can leave and take rest.
Thank you so much, sir. Thank you, everyone.